Hello everybody, welcome to a new RRG video. I'm recording this on Thursday, the 6th of November. It's actually before the US markets open. This week, this video, I want to build on the framework that I introduced in my last video. And apparently that resonated with a few people because I got quite a few nice messages that they like the structured approach in this. So why not continue? Don't fix it if it ain't broken. Let me get started with bringing up the framework and the judgment or the analysis as we did it in the previous video. So here's the view as we set it up the previous time, and that was the 22nd of October. Let me quickly run you through the rationale behind it and the way it's set up if you haven't seen the first video. So basically we start with a portfolio at a portfolio level. And I'm going to use VBINX as the benchmark. That's the benchmark that I most of the time use for my asset allocation RRGs. And we're going to use the same asset classes as the first layer in the, I call it a pyramid. It doesn't really look like a pyramid, but the investment pyramid where you start at a high level and then you break it down into new layers that gets broader and broader. So the first layer is the asset classes, and these are the ETFs that I use for that analysis, and I plot them on an RRG. We're going to see that in a minute. Last time the analysis was for the bond markets, the bond ETFs to be underperforming, stocks to be the only asset class that is really outperforming, commodities were improving, going there, crypto was weakening, and cash, I used the dollar index for that, was also underperforming. And then after that, we go into the next layer. And some of them have the next layer, some of them don't. You could bring them in, but I have decided not to do it because, sometimes it becomes quite complicated or there are not real nice indices or ETFs that you can use to plot them on an RRG. So for government bonds, we do have them. We've got all the maturities on the US yield curve, BIL, SHI, IEI, IEF, TLH, and TLT, going from the very short-term end of the curve to the very long-term end of the curve. And what you see here is that there is a clear outperformance, a clear trend of outperformance for longer dated bonds and an underperformance trend for shorter dated bonds. Corporate bonds and high yield bonds, I'm not going to break down. You could do it, but it's kind of complicated. Maybe you need to go into individual bonds, and that's way beyond the scope of this video and this analysis. For stocks, obviously, we've got the sectors. We've got a nice set of spider sectors, SPDR, State Street sectors that cover all the 11 S&P sectors. And the analysis that we did there last week was especially for communication services and tech to be the outperformers, materials, financials, industrials, and staples to be the underperformers. And then we have discretionary as weakening, and we've got energy, real estate, healthcare, and utilities as improving. Commodities in the improving quadrant or improving analysis, and then we had agriculture and energy underperforming, industrial and precious metals, as well as livestock outperforming. Crypto, I use Bitcoin as the proxy for the crypto universe. Obviously, that's way bigger than just Bitcoin, but I got a feeling that Bitcoin is kind of the benchmark for the crypto market. So I use that as my proxy for the crypto asset class. And obviously, you can break crypto down into individual coins, but there are nowadays also kind of sectors for crypto. And then we've got cash. So that's the framework. This is where we left it the previous time. Let's start and just work our way top down through all these RRGs and see if things have changed, if they have changed, and maybe look at a few individual charts or go very quickly when nothing has changed. Here is the RRG for asset classes. And there's been a few changes, I'm going to say, in this image. The most notorious one is the one for Bitcoin, which has now clearly entered the lagging quadrant, is on the left-hand side of the graph, indicating a relative downtrend versus VBINX. So that means that Bitcoin is now no longer in a outperforming VBINX. So that's quite a move. And you can see the long tail that is on that Bitcoin US dollar price. In the other asset classes, you see a continuation of the moves that were already in existence, and that also goes for SPY, for stocks. That's obviously probably the main asset class for most of us. It's inside weakening. It's moving at a negative heading, but it is the highest ranking on the RS ratio scale. And it's at a very short tail. So that means that it is still in a relative uptrend, and it's very stable. Short tails mean stable. And on the right-hand side, that means a stable relative uptrend. It's going through a bit of a corrective move, hence the weakening position, but there is plenty of room for this short tail to turn back up. So SPY remains the strongest asset class. Stocks remain the strongest asset class. I'm going to change the outlook for Bitcoin to underperform. It was weakening the last time. We're going to change that to underperform because I think this is a very clear negative sign. And then for the other asset classes here, the US dollar remains an underperformer because it's the lowest reading. And then here they are all like curling back up. The problem is that these are all still relatively short tails. So they remain in a relative downtrend. They're improving a little bit. You know, the offsetting what's happening in the stock market. But the tail on DJP, that's commodities, is actually doing pretty well. GSG is also commodities, doing a little bit less well. But if you look at DJP for the commodity complex, it's actually a pretty nice move. So I'm going to change that to a positive. So adding commodities as an outperformer. And I'm going to look at the charts for DJB and Bitcoin, because those are the ones that we're actually changing the outlook for. So here's the chart for DJP, for the commodity index. And you can see the reasons, so the RRG lines both moving up. RS momentum already above 100, red bottomed and rising. That's why DJP is inside the improving quadrant. And you can see that it's still inside the trading range when you look at the raw RS line, but it's working its way higher within that range, and that's been picked up here. But what also counts is the upward break in price, and I'm definitely going to weigh that because this is a bullish setup. This is a bullish scenario after 2.5 years of sideways movement, or at least contained in a quite broad range. Commodities are now breaking out, and that means that the upside potential is actually quite good. And I'm going to say that there is some intermediate resistance here around 37.75, but the target or the next real level of resistance is about 41. That's a very decent return, and if that happens while other asset classes are losing, then that's a relative win. So commodities definitely, I think, are now going to get back on the radar. The second asset class I wanted to talk about with you is for Bitcoin. And Bitcoin, let me look at the weekly chart here. And this is price only. Let me change that to my style for asset classes. Apply. And now you see the Bitcoin chart against VBINX and the relative strength line. And you can immediately see where the weakness is coming from. What's happening here in the price chart definitely looks like a double top being completed. So that's not a very strong sign. If I would draw a trend line here, we're kind of challenging that. But what's more important from a relative perspective and an asset allocation perspective is what's happening on the relative lines. And you can see that it is kind of breaking that double topish formation in relative strength. And that's leading to both RRG lines rolling over, pushing Bitcoin into the lagging quadrant. So despite the recent rise, the weakness now is ending the trend of outperformance. That's probably what I should say here. And we're now basically kicking it out of the asset allocation. The way you should interpret this is that holdings into crypto, unless you're a hodler, HODL, holding on for dear life. If you're a more tactical player in the Bitcoin, in the crypto space, then I think that this is the time to lower your weights to the crypto market. That's from a Bitcoin perspective, of course. So back to the framework. We've looked at all of these, we looked at the RRG and we looked at commodities and crypto in particular. Commodities will be made green and crypto will be made red, which means that going forward, stocks and commodities are the asset classes to keep an eye on. Now let's dive into those three RRGs that show you the government bonds, stocks, and the individual commodities to see what's going on there. So here's the RRG for the bond maturities. The center of the chart, the benchmark here is GOVD. That's that's the entire US yield curve. And the outlook remains as it was last week. There is a very clear preference for longer dated bonds, TLT, TLH, and IEF. And the shorter dated bonds are underperforming the benchmark. So IEI, SHI, and BIL. There's a little hiccup here, but that is not material enough to warrant any changes to the outlook. So for the bond markets, longer term bonds, longer dated bonds are where you should be positioned instead of the shorter term bonds. I am going to take a look at the commodities RRG first and then finish off with the sectors, with the stock market sectors. So we go to commodities, S&P GSCI commodity complex, and this is what we see there. And let me position this a little better. We see here is a very clear continued outperformance for GYX, that's industrial metals, and GPX, which is precious metals. They continue their move. There is a big move in GVX, that's livestock. That's one that I want to look at because this is now accelerating. And that look at that the last two nodes, they're really long and strong. So that signals that there is quite a bit of move behind, quite a bit of power behind that move. GJX remains lagging. I don't think that's going to change. And here, this is an interesting one as well because it's hooking back up. And this is interesting because you may feel that this is going counterclockwise, but what it actually means is that the move was actually so fast that it pivoted around this last node and making this complete rotation at a shorter time frame. So GKX and GVX are the charts that I want to look at from a commodity perspective because I think there might be something cooking there. So let's move to the chart of Before we do that, let me explain one thing to you, because what I like to do when looking at RRGs is to keep it as close as possible. And what I mean is the use of the indices or ETFs. Obviously, you can compare any ETF with any other ETF. But for example, when we look at the stock market, I like the SPDR ETFs. They're all from the same manager. They're all set up in the same way. And for the commodity part, I'm using the underlying indices. There are ETFs that track all of those, but the main goal of looking at an RRG is to figure out where you should get exposure. The way you create that exposure is secondary. There can be various reasons why you use one instrument or another. So in order to get a good picture for the commodity markets, I am using the GSCI groups. And then the overall GSCI index is GNX. That's the GSCI commodity index. So it keeps it into the same family, so to say. That doesn't say because you can't buy that index, you need some sort of derivative instrument like an ETF or a future or something to actually create the exposure in your portfolio. But this way of looking at the markets give you a look at the underlying moves of the actual commodity that we're talking about. So if we're going to look at GKX, that's this one right here, that is agriculture. And you look at the chart and you see that it's actually, that chart is setting up really nicely. We had this massive bottom here around 335, 334, very well respected. And now we've got the first higher low, which is super interesting. And now we're on the verge of, well, if you put it like here, we're already broke it. If you take the extreme here, then we're on the verge of breaking or setting a new higher high. Combine that with a higher low in the relative strength line and taking out the previous high here and both RRG lines to start moving higher. This little wiggle here is that move that you saw on that tail inside the improving quadrant. But for me, this means that this group of commodities, this agricultural complex of commodities is actually starting to really improve. And I actually want to It was an underperformer last week, and it's definitely not an underperformer anymore. So I'm going to make it a improving, so on the watch list type of commodity. Maybe if you're very aggressive, you may want to buy it, but I'd like to wait until we get a little bit more evidence for that. Now, the other one that we need to look at is livestock, and that is GVX. Let me put it in here, GVX, update the chart. And here you see a very different picture. Look at the price chart. This is a very clear, this is a textbook double top. And we're already accelerating lower. We're kind of challenging the first support level here around 474, 475. But there is way more down, and this trend is definitely broken. That also goes for the relative trend, where you see a similar double topish pattern. And it's dragging both RRG lines lower. It's still inside weakening, but it's heading towards lagging very fast. So the positive outlook that we had for agricultural commodities deteriorated really fast. And I'm going to change it from an outperformer to an underperformer, because 22nd of October, that was right here. And this week, we were still, well, we're kind of challenging it, but now we're accelerating lower. So I'm going to put the livestock commodities as an underperformer. So agriculture improved and livestock deteriorated in the commodity asset class. Let's move to the stock market. So here's the RRG for US sectors, and let's see what we can observe here. Let me start with technology. Rotating back up from weakening back into leading. We know that is a strong move. So without a doubt, technology remains the strongest sector in the US. Yes, it's at very high levels. Yes, maybe it needs a corrective move. Yes, all of that. But the relative story here is that it is the strongest sector. It's rotating back from weakening into leading. And, until anything changes in this picture, it remains the strongest sector. If we look at communication services, that is rolling over. This is a sector that has been on the right-hand side of the graph for a very long time. The chart as such is, I think, deteriorating, but the second strongest sector in terms of RS ratio still remains an outperformer, so that is still doing very well. If you look at consumer discretionary, that is actually quite disappointing because it moved into leading, it rolled right over and is now on the verge of crossing back into the lagging quadrant. Based on the chart and the relative picture and it being so close to the benchmark, I'm going to leave it at a neutral weakening type of ranking. It's absolutely weakening, but it's very close to the benchmark. We continue over to the left-hand side, and then we see utilities actually improving, continuing to improve, and we leave that at a kind of neutral improving rating. Look at industrials, that's a definite underperformer, remains in the lagging quadrant. Same for financials, same for materials, same for consumer staples, lowest reading on the RS ratio scale, so definitely an underperformer. So that leaves us with real estate, energy, and healthcare here. Now, energy is rolling over. So we had that at an underperformer, and it's confirming its weakness. And so does real estate. And real estate is interesting because we had that as a improving like energy, but it is now absolutely rolling over, and that makes it a negative. So I'm going to look at the chart, but I'm going to make that an underperforming sector. That's the only change that I'm going to make, because healthcare is the sector with the highest RS momentum, with the strongest momentum in the universe, and it's actually still pushing towards that leading quadrant. Still a little bit of a way to go, but it's definitely a sector to keep your eye on, and together with utilities, maybe the most promising sector in this universe based on the heading of the tails. So let's take a look at the real estate chart to begin with. So here's the chart for the real estate sector. And, we had that trend was down for 2 years already, more than 2 years. The reason it was kind of improving was because of the increment in relative momentum that we saw over the last couple of months. And that was caused by basically slowing down of the downtrend. But with the recent move here, and that is triggered by that move coming out of that slightly upsloping channel, which is definitely a negative sign, that is pushing that relative strength line lower. And that is now, see that little wiggle here? That's now actually causing that trend to hook back down, pointing towards the lagging quadrant. So real estate is going back from a improving back down to lagging. It's making that hook back down. So it's joining the group of sectors that are clearly underperforming the S&P 500. And when we bring that back to our RRG framework, then we can see the changes here. So this is last week, last observation. And if we go to the one today, you can actually see the changes. Real estate is the only one here. And then in the asset classes, you see commodities going from blue to green and crypto going from yellow, orange to red. So that's the changes on an asset class level. In the sectors, we only see real estate going from blue to red. And in commodities, you see agriculture going from red to blue and livestock going from green to red. And that is the setting as we have it at the moment. Wrapping it up, I want to share two more charts with you that I keep an eye on. Those are kind of breadth charts because, everybody talks about that the rally in the S&P 500 is based on narrow breadth, narrow foundation, and that's absolutely true. But let's put that into a picture. So what you see here is the S&P 500 with the chart of the new 52-week highs. This is a weekly measure. It's very different from the daily measure of new highs. Bear that in mind. And what I think is interesting is that if you go back in history and you look at the rally, so you see here, this is 2017, you go to a peak and you have very high readings of that new high indicator. Go through correction, and then you rally, and you go to clearly a new higher high in price, but look at where the number of new highs is. It's very much lower, and that precedes that pretty serious decline. And then here we have this rally, which is actually confirmed, and that's COVID, so it didn't really work here. But now look at this one. You can see during the rally, every time you got more new highs, more weekly new highs. And then the last bit of the rally, that number of new highs starts to decrease. And it actually starts to decrease quite rapidly. You got a little bit of a hiccup here just before the move down. And so that is actually the expression of narrow breadth. In the beginning, lots of stocks are participating, making new highs. And then at the last part, it's a much lower number of stocks making new highs before the market goes down. And then we do it again. So here, you can see every time when the market peaks, you got more stocks making new highs, which is absolutely confirming. And now here's interesting because here you have that at the peak, you got a much lower number of new highs, and then we got the decline. And now we start moving higher again. So the question that I am asking myself now, is this the start of a new move? Is this a much lower reading than we had here, and are we in for a turnaround of a bigger magnitude? This is not, for me at least, not a primary indicator. It's not like, oh, this is happening, you should sell now, because if you look back in history, that would have been a bad idea because you are missing the best parts of the rally. But it's definitely something that I want to keep an eye on because it is something that tells us a story. Story of the market is that the rally is getting narrower and narrower. And the other chart that gives some sort of perspective there is the number of stocks trading above a certain moving average. And that is this chart here. This is the S&P 500. This is the number of stocks trading above its 20-day moving average, its 50-day moving average, and its 200-day moving average, each time with a 10-period moving average of that indicator. So what this tells me is that, so the top one is the number of stocks trading above their 20-day moving average. That is deteriorating, and it's now only 38% of the stocks in the S&P 500 are trading above their 20-day moving average. For the 50-day moving average, it's 41%. 41% of the stocks in the S&P 500 are trading above their 50-day moving average. And then the last one, everybody's watching the 200-day moving average, and it's slightly above 50. 53.5% of the stocks in the S&P 500 are trading above their 200-day moving average. But look at this. All of these indicators are moving below their 10-week moving average. So that trend is declining. So that's also a message showing that the number of stocks trading above their moving averages is getting lower and it's declining, meaning that the rally is being carried by a decreasing number of stocks. So much less stocks are now participating in the upside move. Don't want to make a drama out of it, not a crash prediction, but it is definitely something that we need to keep an eye on, especially if you just look at the rally here. It wouldn't be bad if we had a bit of a correction. And if you look back in history, these would be like no issue at all. This was a very important move, moving above that 6150 resistance. Coming back somewhere there, no problem at all. So we saw the sectors, communication services, and especially technology continue to lead. If we look at the market as a whole, there's a bit of risk getting into the market. We're getting at elevated levels. Is it a super bearish constellation? No, I don't think so. Thank you for watching. I hope you liked the show. Tell me what you think in the comments. Do you like the framework? Should I change something? Add, delete, etc. I love to hear your thoughts. And I'm looking forward to seeing you again at a new video on RRG in the future here on Stockcharts Television.